Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings for the first quarter of fiscal year 2024, and that stock is Kroger. And we can see that over the last year, Kroger is down around 3%. The rest of the market is up 11%, so they're underperforming the market. But in this video, I'm going to look into some of the recent news that came out surrounding Kroger. I'm going to look at their financial statements and then use a discounted cash flow model to figure out the intrinsic value per share for Kroger. And so this article right here is titled Kroger-Albertsons merger still on track. Obviously, there was big news that came out a few months ago that Albertsons and Kroger would be merging. And so we can see right here, the chairman and CEO, Rodney McMullen, announced in their earnings announcement that the pending acquisition of Albertsons is still on track. They're just waiting on regulatory approval, and they're also planning the merger. It's a $25 billion deal. But we can see right here that consumer advocacy groups, along with U.S. lawmakers, are basically concerned that this will lead to a retail monopoly. And so they're trying to get Kroger and Albertsons to divest some of their assets and basically sell around 250 to 300 stores. So right now, Kroger is working cooperatively with the regulators, and they are also at the same time trying to identify potential buyers for their storefronts so that they could divest in accordance with lawmakers and advocacy groups. They basically set a limit for the merger between Kroger and Albertsons to sell only 650 stores total. So they don't want to get rid of all of their stores because that would obviously be bad for business. But in total, the merger would bring together more than 2,700 Kroger stores and 2,200 Albertsons locations. So obviously combined, that would be basically 6,000 stores that all belong to Kroger. So that would make them very big, and that would definitely increase profit margins because farmers and people who grow crops and goods who sell to these supermarkets would have less options, and so Kroger would basically be able to set their price, and that would end up leading to larger profits for Kroger. And so right here, these are their financial statements. I'm going to look at their income statement, balance sheet, and cash flow statement. We can see from their income statement, revenue increased year over year by 1%, from 44.6 billion to 45.1 billion in the first quarter. And we can see that earnings increased 44% from 600 million to a little over 900 million. So even though the revenue only increased 1%, earnings increased around 44 to 45%. And that came primarily due to a change of 85% decrease, as you can see right here in their loss from investments. In the first quarter of 2022, they lost 530 million, but in 2023, they only lost 78 million. And that was the main contributor to this big increase in their earnings for the first quarter. Then for their balance sheet, we can see total assets are up from 49 billion to 50 billion dollars. Most of their business is financed by liabilities. They have 40 billion dollars of liabilities and a little under $11 billion of total equity. And of their equity, they have $26.3 billion of accumulated earnings, which is up from $25.6 billion in the prior period. So they do have more capital to return to shareholders if they so please. And then right here, lastly, in their cash flow statement, we'll get a better look at how much capital they're actually returning to shareholders. Their operating cash flow increased from 1.1 billion to 2.8 billion. So that's an increase of about 160% for their operating cash flow year over year for the first quarter. And then in their financing activities, we can see they paid out $188 million of dividends in the first quarter compared to $150 million a year ago. So they are still prioritizing returning value back to shareholders. They have a pretty good dividend yield, as we can see right there. And so right here in this Microsoft Excel, this is a discounted cash flow model to figure out the intrinsic value per share for Kroger. Yahoo Finance is basically estimating that the company is going to grow at 8% for the next 5 years compounded annually. They have about $2 billion recorded for free cash flow for their most recent full year. They have $17 billion of debt on their balance sheet after subtracting cash, and a little over 700 million shares outstanding. That puts their intrinsic value per share at $16 per share, which means that at the moment they are currently not trading below intrinsic value per share based on those estimates. They are currently trading at $46 per share. So that means at the current share price, based on these growth rate estimates, they are not trading below intrinsic value right now. Then right here on the right hand side, I did a competitor analysis comparing them to Albertsons and Target. We can see that across the board, looks like Albertsons has the highest gross profit margin, Target has the highest net profit margin, and they also have the highest return on assets. Albertsons has the lowest PE ratio. Kroger comes in a close second at 13 times earnings. And then we can see the dividend yield across all three companies is basically the same. Target pays slightly higher at 2.46%. So basically for every $100 you invest into Target, you're going to get paid a dividend of $2.46 per year. For Kroger, it's $2.20. So it's basically the same thing. Obviously, the dividend for Target is way higher because Target has a higher share price, but we can see the dividend yield is basically the exact same thing. So from a competitor analysis perspective, just in this retail and supermarket industry, it looks like for profit margins, it goes to Target mainly, but for basically which stock is cheaper, it would probably be between Kroger and Albertsons, seeing as Target is trading at 22 times earnings. And then for dividend, they all pay a pretty good dividend, right around 2 to 2.5% dividend yield. And lastly, to end off the video, I wanted to compare Kroger to the other companies we've looked at in past videos. Kroger at the moment, as we saw from the discounted cash flow model, is not trading at a good share price compared to intrinsic value. The intrinsic value is $16 per share, and Kroger is trading at $46 per share. So they're basically trading at around 2 to 3 times their intrinsic value per share, which is not good enough to get them onto the table. Meta is doing the worst on the table at 1.3 times their intrinsic value at the time of making that video. So far, Google, Alibaba, GE, and Etsy are the only companies we've looked at that are trading below their intrinsic value per share. Then right here, we can see growth rate. Kroger had an 8% growth rate, so they are not good enough to get onto the growth rate table. Nvidia holds the number one spot with a projected 33% growth rate. We can see for gross profitability, Kroger had a 19% gross profit margin and a 1.5% net profit margin, which is not good enough to get them onto either profitability table. Adobe has the highest gross profit margin at 86%, and Microsoft has the highest net profit margin at 36%. Then on the bottom here, we can see that I compared Kroger in a new way to past companies. These charts were recently added in the last video that I made about Adobe, which is why they haven't been filled out yet. But so far, we can see Kroger has the number one spot ahead of Adobe for dividend yield. Adobe doesn't even pay a dividend, so that's a pretty easy spot to take. And then on the right-hand side here, comparing them for Q2 year-over-year revenue and earnings growth. I put Q1 fiscal year 2024 next to this because the second quarter of the year, which is usually where most companies announce their fiscal second quarter results, is actually the first quarter for Kroger. So even though it's in the same time period, it's Kroger's first quarter fiscal year 2024 results. But I still decided to include it because it's in the same 3-month period. So we can see that Kroger had a 1% year-over-year revenue growth for Q2, which is not as good as Adobe's 9.9% or 9.8%. But we can see that for earnings growth, Kroger beat Adobe out of the water with a 45% net income growth year-over-year for Q2 compared to Adobe's only slightly under 10%. And then to end off the video, I am comparing the companies based on stock performance over the last 5 years. Kroger, as we can see right here, improved a little over 60% for the last 5 years, so that's not good enough to get them onto the top 10 table here. Tesla holds the number one spot at a little over 1,000%, or in this case, a little under 1,000%. But that was at the time of making the video when they were trading at $203 per share. Now they're trading at around $240 per share, so this percentage has increased since making the video, but we can see they are holding the number one spot. Adobe holds the number one spot at up 90% over the last 5 years, which is why Kroger's 60% is not good enough to get them onto the table. So based on this, we can see that across all of the companies we've looked at, they're really not that competitive at all for stock performance, profitability, growth rate, or share price compared to intrinsic value. But on the newer tables that I've recently added for dividend yield and year over year revenue and earnings growth, they are doing slightly better than Adobe. And for those results, they're doing better than Adobe for 2 tables, but Adobe had the better year over year revenue growth. In terms of the industry analysis, we can see that if you're judging them based on profitability, you probably want to give it to Target. Based on dividend, they're all pretty much the same, but Target does have the highest dividend even still. The cheapest companies are between Kroger and Albertsons. They're both trading at 10 to 13 times earnings, whereas Target is trading at 22 times earnings. So you'd probably want to give it to Target all in all, just because they're more profitable and they pay a higher dividend. And then for the discounted cash flow model, we saw that they are not currently trading below intrinsic value per share. So based on this video, it looks like obviously Kroger has a pretty interesting up and coming catalyst with the merger between Kroger and Albertsons. But so far, they aren't really that competitive compared to the other companies we've looked at. They're not trading below intrinsic value per share. So I'm not too sure what to make of Kroger. They're pretty competitive in their industry, and they're going to be even more competitive if the merger goes through, because they're going to have all of those stores under one name. So let me know in the comment section down below what you guys think of Kroger. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.